All right. Well, with that, good afternoon, everyone, and welcome to Stewardship of Your Organization's Investments, our final not-for-profit webinar of the year. Thank you so much for joining us. Broadcasting live from our Indianapolis studio, I am Michael Barton, and I am joined this afternoon by my esteemed colleague, Christine Gismondi. Christine and I are both audit directors here at Sikich within our nonprofit group, if you couldn't already tell. If you guys were sad that maybe the polls were going away after this past Tuesday, the good news is we got more polls for you here this afternoon. So if you were down or sad about that, I guess unless maybe you're in the state of Georgia, we'll have some more polls for you. And Christine, I will let you take it from here.
Okay. Sikich does host webinars several times a year pertinent to our not-for-profit industry. If this is your first time joining us, welcome. Sikich is a professional services firm supporting the not-for-profit organizations through our audit, tax, accounting, advisory, and technology solutions. As you can see in the graphic, we are more than a CPA firm with an award-winning technology practice and a robust advisory practice. Our team serves a variety of not-for-profit organizations, including higher education institutions, social service agencies, healthcare organizations, foundations, and more to help you support your mission. We have team members and clients across the United States, and we enjoy being able to connect with all of you today virtually. Before we begin our discussion, I do have some brief housekeeping items. I encourage you all to use the questions feature. I'll be monitoring for your questions, and we will definitely take some time to cover them either through the course of the discussion or at the end. If your questions cannot be answered during the presentation, we will follow up after the webinar. The slides for today will be available to you to download. And of course, there are CPE credits offered for the presentation. Those polling questions that will launch throughout the webinar, you'll need to answer those in order to receive credit for attending the presentation. At the conclusion of the webinar, you'll see a short survey. It's the one that's going to say, hey, these people did great. And you'll also need to complete an evaluation for CPE credit. Certificates will be emailed to you in about 2 weeks.
All right. Thanks so much, Christine. All right. Now, the moment we've all been waiting for, let's meet our man of the hour and, more importantly, our presenter, Mr. Andrew Peone. Andrew is a partner here at Sikich who leads our Sikich financial team. Andrew also has years of experience working with a wide variety of clients and advising them on investment strategy. Andrew, in speaking with my clients, and it seems especially true in these challenging times, that organizations, governing their investment portfolio, it seems like a real challenge in these uncertain times. Interest rates out there, other fluctuations in the stock market. I think I saw today, it's going gangbusters. Last week, it's going the other way. And these are the kind of challenges and things that, keep these groups up at night. And that's what brings us here today.
Yeah, Michael,
Andrew,
you're right.
Thanks for joining, and I'll let you take it.
Sure. Thanks, Michael. Yeah, you're right. Our financial advisors have been working with a lot of nonprofit clients in the past couple of years. And it's awesome because we've been able to help them accomplish their mission by adding our expertise to the board, the things the board's doing and not able to accomplish on its own. During COVID, no one really wanted to admit it, but a lot of non-for-profits were flooded with cash from either government programs or donors wanting to help where they could. Many of the non-for-profits we were working with did not want to let everyone know they were receiving a lot of funds because they didn't want the inflows to stop. So they are flush with cash, and quite a few of them stored away to prepare for leaner times, and that's why we're able to step in and help. Today we're going to talk about, different types of accounts that nonprofits can own or open, what an investment policy statement is and why you should have one, and then best practices for nonprofit boards. So before we get started, I believe Kelly's got a first poll question of the day for everyone.
Does your organization have a true endowment or a brokerage account? Please select either endowment, brokerage, both, or I'm just not sure. We'll give it a second here and then see how everyone fares in our audience. We go 18% with endowment, 53% with brokerage, 9% have both, 21% aren't really sure. So Andrew, I think we're going to learn some stuff today.
Yeah, that's awesome. Yeah, so thanks, Christine. So let's talk about the different types of nonprofit accounts that, let's see here, nonprofit accounts that there are. So first of all, there's endowments. The purpose of endowment is to earn a profit and sustain an organization into perpetuity, which basically means forever. When people think about large organizations and colleges like the Harvards or the Yales of the world, they think about endowments. Endowments may have some kind of guidelines like a spending policy of 3% of the principal, depending on certain guidelines. Foundations are really, they're nonprofit corporations or charitable trusts that make grants to organizations or institutions. They're not specifically owned or operated by a nonprofit, but they're usually something somebody set up or a group set up basically to fund nonprofits. It includes community foundations, donor advised funds, or private foundations that make grants to organizations. And lastly, there's investment accounts or brokerage accounts or board designated funds. These donations are set aside but not restricted. So if money comes in for a children's food drive, it may be set aside in an investment account if it's over the course of multiple years. It can be set up by nonprofits to help with the long-term funding goals of an organization, but may not necessarily adhere to strict guidelines of a true endowment.
And Andrew, before we move on, I think it's so important for organizations to really distinguish what kind of account do I have? Like you just touched on, is it a true endowment? Is it just a brokerage account like our our previous poll had? I feel like we've worked with a decent amount of organizations recently where I think even they were confused. They operate it like an endowment, but it's not really donor restricted. I think it's helpful to everyone, in particular with your investment committee and your board, to fully understand, what kind of account is this? How can we spend this money? Is it donor restricted? Board designated? I think it's really important for groups to define what that money is.
Yeah, you're right, Michael. I mean, and that's what the purpose of investment policy statement is. So even if you have, typically people think of an investment policy statement or IPS with an endowment, but even if you have money set aside in an account, it's always nice to have one. So we'll talk a little bit about why that is and what an IPS is composed of. But I know first, I think we have one more polling question to get started. So let me move over here.
Does your organization have an investment policy statement, an IPS? Yes, no, not really sure, or it's just not applicable. Give you a minute or so to get that answer in. Just making sure everybody gets it in so that we can get our credit. Okay, 74% of you have an investment policy statement. 12% of you do not. 6% are not sure, and 9% it's not applicable to them. So that's actually really a nice percentage. Impressive.
I am proud of our group.
Overachievers. So let's talk a little bit about an investment policy statement, or what we call an IPS, and talk about what it's composed of and why you should have one. An investment policy statement is a client-specific document designed to address the objective constraints and unique circumstances and overall oversight procedures that govern the investment-related activities of a nonprofit organization. It should be easily understood and executable. So even if you have an attorney or a financial advisor on the board, a layperson that's on the board should be able to pick it up and understand it. It provides a guideline for current board members and members in the future. So if your board this year puts one together and everybody agrees on it, and then everybody rotates off the board in the next 2 or 3 years, the new board members should be able to pick it up, read it, understand what the purpose is, and how to interpret it. And I got a note here to move slides, I'm sorry. So the purpose of scope really breaks down, it basically provides an overview and sets the tone for specific guidelines within the body of the document. It's really the bumpers on a bowling alley. So it helps you to understand what you're doing and why. So what's this money here for? What's it used for? What the main goal was, why it was set aside. It also includes definition of duties, board of trustees, who they are. The board ultimately has a fiduciary responsibility of the foundation's investment portfolio. The board sets and approves the IPS and then delegates responsibilities to the finance committee for implementation and ongoing monitoring. And you may also have an investment and finance committee that it monitors a little more closely. So the investment committee is responsible for implementing the investment policies. It approves the investment policy statement. It looks at the RFPs, it issues the RFPs, it hires the investment manager, monitors the portfolio, and ensures compliance with the IPS. If a board's small, it may be 5 or 6 members, it may not be a finance or investment committee, but it is good to separate. If you have a large board, to separate that off so somebody can monitor the portfolio.
And Andrew, you mentioned a good point earlier about your bowling alley analogy. I think it's so important. Why, if it looks like a majority of our group does, but if you didn't, why having your investment policy statement, or as the cool kids call it, the IPS. Why that's important is for those turbulent times, good and bad. I think it's nice just to go back to your fundamentals. No, this is what our investment policy statement says. We can't invest in X, Y, Z, or take chances like we would if it was our own money. I think that's so important for organizations to understand, and especially in these economic times, when the market's doing crazy things. Just going back to your base or kind of your fundamentals, so to your speak, at your policy statement, I think it's just a really good point you brought up. And then Andrew, or actually I might let you respond to that real quick, Andrew, and then I actually do have another question that came in.
No, that's good, Michael, because I mean, you could have multiple objectives. So if you have multiple accounts or multiple objectives, really the investment policy statement keeps you on track. And we'll talk about how it goes through investment objectives and allocations. But basically, when the market's down like it is now, you stay in focus for the long term.
And it's interesting you bring up kind of multiple objectives. One question we actually got in the chat here, as it pertains to bigger organizations, they might have multiple causes, or they might have maybe multiple campaigns for different causes or different funds. How do you fit all those different things in your investment policy statement? What would you tell those groups?
Well, you want to basically establish what the investments are for. So if you had a organization that wanted to feed children or help the homeless, or do multiple things, you want to break out like what percentage of that account is going towards those targets, or how much you're going to spend on an annual basis. Or you might separate it into different buckets. So you might have one account set aside for one objective, and then another account is set aside for a second objective. So you can really break it out how you want to, but it should be outlined and easily understood. Good questions. So let's talk a little bit about the investment objective. All investment policy statements should clearly articulate investment objectives with an outcome-oriented mindset. So the portfolio is required to spend 5% a year. It should articulate how much risk you want to take, what your time horizon is. The investment should focus on not on short-term gains, but also long-term sustainability of the organization. And it's tough in times like this year, where the market's been volatile, the market's been fluctuating, stocks are down, bonds are down. But it really gives you an idea of like, here's the next 5, 10, 15, 20 years, here's where we're going to go, and here's how we're going to do it. A lot of times you'll also have things like where if you get donations of stock by donors, here's what the investment objective is. Like if a donor were to donate a highly appreciated stock, you put it in the portfolio, it rebalances back into the asset allocation, which we'll talk about next. So really, it'll cover things about how, like, what your long-term stocks and bonds, and it may also, and this may be a little more in the asset allocation framework. It's like, what happens if you do individual stocks or donations of like things like crypto that's not normally in your portfolio. And I know, Michael, you've had that happen a few times with some of your clients too. Oh, we lost you, Michael, on the mute.
Sorry about that. Rookie mistake. You think 2 years into COVID, we'd have this figured out with the mute button, but no. What I was saying when you couldn't hear me, I think especially of late, that's so true, Andrew. We've had clients, being gifted cryptocurrency, for instance. I think that's things boards are going to need to think of. As that becomes more popular. I mean, obviously it is already, but as that becomes more widespread with all ages of people. I think that's going to be a continuing trend we're going to see. I want to donate Ethereum to XYZ organization. Well, what is XYZ organization going to do? Are they going to hold it? Are they going to liquidate it? Instantly upon receipt. And I think that's just such a good point. What do we do with that money? And I think that's really important to include in your investment policy statement.
Yeah, and it really plays into your asset allocation framework, because if you're 60% stocks and 40% bonds, somebody gives you a large donation of stock and the stock's doing well, a lot of times it's like, well, let's ride it and see what happens. And, it's doing well, let's not sell it. But you really want to stick to your investment objective. It's not about, the hot thing in the market. When you look at the asset allocation framework, you're looking at how much do you have in U.S. equities, how much do you have in international equities, emerging markets, fixed income, real estate, and alternatives. This can really be broken down even further. And, I've seen some investment policy statements say, here's how much you should have in large cap growth and large cap value and mid cap and small cap. And so what that really means, sometimes people hear those terms, they don't really know what it means, but large cap growth is, big companies trying to get bigger. So think about Amazon, think about Google, think about Starbucks, where they're not actually paying a ton of dividends, but they're trying to build more stores and expand and grow. And value stocks are more dividend-paying companies, so like the J.P. Morgan Chases or Verizon or AT&T. So you want to basically build a framework and say, here's what our allocation is. And once we're outside of that allocation, or one of those sectors is outside of the allocation, we're gonna kind of tone it or rebalancing it back into place. So it's gonna be your target allocation, your approved range, and your liquidity profile. One thing one of our colleagues mentioned, Jill Boyle, said if you have alternative investments, you want to make sure you know what they are, or even international investments, you want to make sure they know what they are and what the tax filings are. So she's had a lot of clients that have been shocked by paying taxes that had K1s they didn't know about. So it can make your tax return a lot more complicated, and it also can increase the cost of the audit. So if you have international or alternatives or things outside a normal range, just make sure you know what you own and why.
And Andrew, to go along with that, we have some clients, possibly some on this call even, with that 501c7, being a charitable organization under that umbrella, sadly they are taxed on some of that investment income. This affects a lot of the fraternities we work on. And I think sometimes, I'm thinking of the fraternities in particular, those fraternities may not necessarily think about that, when they're out doing their asset allocation. They probably want to be thinking more about that appreciation, right, as opposed to those high, dividend yields, just because, anything over that $1,000 kind of UBIT threshold, they're going to start to have to pay tax on. So I think that's a really good point you bring up there.
Sure. So let's talk a little bit about rebalancing. So we put together the asset allocation framework and say, here's our allocation. If it's 60% stocks and 40% bonds, and right now the market's down, but let's say the market goes up 20%. Now instead of 60% stocks, you have 72% stocks. You want to have either a quarterly rebalancing where it automatically rebalances no matter what, or you may have a what's called drift profile. Yeah, where you say, if it's more than 65% stocks or less than 55% stocks, we're going to go ahead and rebalance or look to rebalance it in the quarter. So really, it's getting you back into your predetermined range. It's not changing your risk tolerance. It's not taking you, like you may have a range of being okay with 60% stocks up to 70% stocks, but you're not saying, the market's kind of choppy right now. Let's go from 60% stocks down to 30% stocks because I don't really know what's going to happen. But it's basically to get you in line with that long-term investment profile. You also, one thing in the investment policy statement will be what we call a liquidity profile, or policy. So stocks and bonds have daily liquidities, meaning that if a stock is trading during the day or an ETF or mutual fund, you can sell it. and it usually settles within 2 days, and the organization can get the cash within, generally a week. But alternative investments or real estate may not have daily liquidity. So you want to look at the investment policy statement, what the money's there for. If you're going to need it in the next year or 2 or 3, you want to make sure that the money's there when you need it. So you really want to have a liquidity policy. And this also lends into, generally, like for individuals, when we work with them on financial planning, we'll think about emergency funds. So we may have our IRA and Roth IRA or investment accounts, but we also have, cash set aside for the next 6 to 12 months of savings. So a liquidity policy can really have, here's how much we're going to set aside in treasuries or CDs or cash too. So if we need money, here's where we can access it. So let's talk about the spending policy a little bit too. So a spending policy really should be clearly defined. You're going to look at your upcoming expenses the next 1 to 3 years. So if you're invested in the market, stocks, next 5 or 10 years, generally over time there'll be fluctuations, but the long term looks a little more stable than what the short term would. You want to look at your upcoming expenses the next 1 to 3 years and know where your liquidity is coming from. It's tough when you have spending with an underwater endowment. So this year the market's down 20%, bonds are down 16%. It's been the worst year for what we call a 60-40 portfolio, which means 60% stocks and 40% bonds. But you want to have in place of even in times like that, which happens. So I know, Michael, you've had some experience with that too. What's your experience been like on that?
Yeah, I apologize. I actually lost my hearing here for a second. I actually had a question I was asking you, and then you kept going. So if it's okay, I might back up to there, and then we'll come forward if that's okay.
Sorry.
So that's just that's our studio production right now. Yeah. Hey, Andrew, one question that came in. I think this is such a good question. I apologize if you just touched on this. And we hear about this all the time in the personal finance realm. Like, every year you got to look at, rebalancing or reallocating. We expect the market to do this. Let's shift, 40% one way or another. How frequently should our, nonprofit organizations be thinking about that with their investment policy statement? What would you recommend to those groups kind of, putting that piece into it?
Well, in your long-term investment policy statement, you really want to set it for the next 5 or 10 years, not for the short-term fluctuation. So, inflation's up right now. We'll talk about this a little bit. Inflation's up, the market's down, things like that. So, but you really don't want to shift it based on current market conditions. You want to say, okay, the economy over time will, recover. And even though Walmart's having some problems right now, it's going to be good in the next 5 or 10 years. Or Amazon's it's down right now. It's still going to be a good company. And so you really want to look at that. The nice thing is when the market's down and new cash comes in, you're investing in lower value. So you really want to keep a long-term perspective on that. You may have small fluctuations where you're saying, based on market conditions, we may have 5% emerging markets and let's move it to 4%, but you shouldn't make big shifts on a given year if everything's still constant.
Yeah, and one thing actually came across our wire that I want to kind of point out. This is a comment from one of our Sikich employees, just talking about allocation or rebalancing for this coming year. And I thought this was an interesting comment, and it reads, one thing to keep in mind is that we're seeing boards approving higher spending rates, to offset operating losses. This year had significant losses in their investment holdings, but these organizations still needed to take a larger draw to kind of make up for that shortfall. A consideration is that management should consider a plan for assessing going concern when approving these larger draws, as the auditors will ask about it. In addition, can consider only drawing on funds to the original principal balance, not taking individual funds underwater. So I think principally they need the cash, right? But they also don't want to deplete their investment account. Any thoughts on that?
It's tough because, technically you should think about your liquidity or cash deposits beforehand, but life happens. And so sometimes when things are going badly, everything's going badly. And so it's tough when the market's down 20% and then you take out 10% and now you're down 30. So anecdotally, what I always tell people is if you start with $1 million and it went down 40%, and you took out 10%, now you're to 500,000. You have to go up 100% just to get back to even. And so we look at sequence of returns and things like this, but if you can keep it constant, generally it should stay in for the long term. But there are times where, you know, an organization might need money because something changed or they had an emergency. I don't know if that answers your question.
Yeah, and, you know, no, I think that's definitely helpful. And, you know, just other questions that have kind of come in, you know, I think groups struggle with this at times, and, you know, definitely, I think, you know, balancing your portfolio is certainly a piece of it, you know, but when we look at, you know, kind of what those, you know, what should groups expect in terms of that target return rate, you know, over that 5-year period we're talking about, right? And we'll talk about that going out piece next, but, you know, what would you recommend to groups? What over a 5-year period? What's a good average rate of return you think, you know, on those investments?
Well, generally look at like 5 or 10 year periods, but on the equities or stocks, you know, you can pretty fairly anticipate 8 to 10% right now. I know in the future, like last year, the market ran up, so they were lowering their expectations. But right now, let's just say if you anticipated 8 or 9% for equities in the long term, and with the movement of rates moving up, which has created a lot of volatility, but right now bonds are yielding about 4%. So if you were to have a 60-40 portfolio, so 60% of your stocks was gonna, you know, targeted to earn 8 to 9% in the next 10 years, and then 4% of your or 40% of your portfolio is targeted to earn 4%. You may have a target return rate of, you know, maybe 6% of the portfolio, depending on your allocation to stocks and bonds and different asset classes. And so you really want to look and say, okay, if we need to earn 6% for the long term, here's how much risk we need to take.
Gotcha. And then, you know, kind of on the flip side, we kind of just talked about this. You know, let's talk about the not as fun side, the taking money out, right? That always scares people. You know, and Christine, feel free to give input on this too, but what do you normally see organizations do in terms of that drawdown rate? Like just, you know, for our audience.
Well, so if you are earning 6 or 7% and you're taking out 3 or 4%, if let's just for simple terms, if you earn 7%, you take out 4%, that allows you to stay in a portfolio and still grow the portfolio. So it grows at 7%, you take out 4% on a given year, it should be up 3% the next year. Obviously, markets don't move in a static fashion, so long term, you know, the portfolio may be up 10% one year, down 20% the next year, up 15%, down 4%. And so a safe withdrawal rate over time, you know, after expenses is usually 3 to 4%. So it may be 5% in a given year, but if you have a little more aggressive and you have a larger portfolio, you may be able to handle it.
Gotcha. And you know, I'll just say this on my end too. You know, sometimes not always the fixed rate works for everybody. I know we have some clients where they might do it, you know, they might take that average balance as of a certain date, February 28th, whatever, you know, divide that by 3 and, you know, calculate their spending amount from there. So I think there's all kind of ways to do it. But again, I think that's something good, you know, for groups on this call, you know, to think about incorporating into their, you know, investment policy statement if they have not already.
Now that's the smoothing effect of an endowment too. So like a more formal endowment may say, take it over the course of certain years, so that if it's up 1 year, we're not taking a huge amount out, and if it's down 1 year, we're not taking less. And so it allows them to smooth the withdrawals over time. It's a good point. So let's talk
and then Andrew, actually one more thing came in. I think this is a great question just with our current state of, you know, economic affairs. You know, what do organizations do with an underwater endowment?
So I mean, really, we don't. So I think this is a little more on your side too. But and I thought we talked about this a little bit maybe. But really, with the underwater endowment is you have to figure out how much you're going to take out and if you should cut back withdrawals and really look at the portfolio and, you know, what the long-term sustainability of the portfolio is. So it may be that, you know, withdrawals change based on an underwater endowment. So.
Yeah, I think, and this is something we ran into recently too, right, Andrew? I mean, we're busy working on a lot of June 30 year ends. You know, we had a lot of unrealized loss positions then, right? I mean, I think a lot of people on this call can, you know, sympathize with that. relate to that. You know, and it's a common question. Hey, we're underwater. What do we do? Well, ultimately, it goes back to your investment policy statement. Yes, you can spend from it, but you got to define it. You can't just make up the rules as you go. So I think that's a really good question. I mean, the easy answer, sadly, what do we say in our investment policy statement? So as boilerplate as that sounds, we're not punting on that. That is the right answer.
No, an investment policy statement can be changed, but you don't want to change it every year based on what you need for that year. So, or what the board is. So it really should be defined. An investment account may have a little more flexibility to it, where you say the market's up right now, let's take a little bit out. A formal endowment's going to have, predefined spending. So let's talk a little bit about responsible investing. So responsible investing is really values-based investing. So, what does your organization do? What do they value? Do you want to invest accordingly? So traditionally, we thought about this like in spin stocks. So we may have a religious organization and say, or a community and say, we don't want to have tobacco in there, or we don't want to have alcohol or abortion or weapon systems or pornography, or there's a whole list of things that you say, I just don't want this stuff because it doesn't align with our values. Things have evolved a little bit, and so now we have more what we call ESG, which is environmental, social, and governance. So think about with environmental, it's a little more like, we want to screen, companies that have greenhouse gas emissions, deforestation, climate change, resource depletion, waste and pollution. With social, in the S in the ESG, is employee relations and diversity, working conditions, which include child labor and slavery. It can be local communities seeking to fund projects or institutions that serve poor and underserved communities globally. You can think about things like health and safety or conflict. And lastly, the G of the ESG is governance. So tax strategy, donations or political lobbying, corruption or bribery, board diversity and structure. So a lot of times people think about ESG and that they, based on our organization and what we do, how does this incorporate this, and can we invest in things we care about? You got to watch out sometimes because there's, things we call like greenwashing, which greenwashing is the process of conveying a false impression or misleading information about how a company's products are environmentally sound. There's also some interesting things with ESG right now where you had in the past few years, companies like Tesla were in there because they're electric vehicles, and then they had some issues with racial discrimination of the company, so they got dropped out of the ESG indexes. And then you had companies like Exxon that were out of there because of the oil and gas, but then they started moving to more green energy, and so they got added back in. So I think it's still a moving target, but it is interesting. And there's, you can see if there's something that, your organization cares about, can you invest in it? Does it make sense for you? And you don't have to do the whole portfolio. You can say, let's take a small portion of the portfolio and invest in this, and kind of try to align with our values.
Yeah, I think that's a good point, Andrew. And gosh, I remember when that story came out 6 months, a year ago about, how Tesla did not make it in there, but, Exxon was, and you're, just naturally you're thinking, well, wait a minute, we're talking, oil versus, electric cars, we're kind of doing opposite things here, right? And so I think those other, characteristics you just mentioned is, a good key distinction of what they're looking at there. So I think that's a good thing to point out. One question though, Andrew, for you, how do we incorporate, these ESG funds, or other ESG investments, how do these groups on this call, if they want to, how do they incorporate that into their investment policy statement?
Well, you want to, under the responsible investing or like a section like that, you want to maybe make a notation of here's what we're trying to do. So there's funds that we use that are like what we call separately managed accounts, where you can see all these different stocks in there, but you can also screen and say, okay, we don't want to have a tobacco stock in there. We don't want to have an alcohol stock in there, but you can also say we want to tilt the portfolio to more, green powered. So, or electric vehicle or sustaining or carbon credit type organization. So you can do it that way. There's also funds where we had an association that really, how do I say this? They didn't really have anything that they were targeted to based on their association, but they wanted to have something in the portfolio that they had a mutual fund that screened out weapons like handgun manufacturers. So, it really depends on the organization. And sometimes I've seen organizations get kind of go down the rabbit hole with these, but you want to make sure it kind of like, or think about like what's important to you, and is it worth screening things out, and do you want to do a portion, or do you want to do the whole thing? So
yeah, I think that's a great point. I think as we go here, in particular in the near term, I think with a lot of nonprofit organizations, this is going to be something weighing heavily on their minds. So that's some good commentary.
the ESG too is a little bit, they're still navigating through it. So ESG can mean different things to different people and different companies. And so when you see things that you're screening out, or you see ESG, make sure you know what you're investing in and why you're investing in it. So I'd be like my last comment on that. Under unique circumstances, this won't apply a ton, but this is kind of where Michael was talking about UBIT. And so there may be some things where you want to think about your organization. If there's some things with like fraternities and things like that where you have to screen things out. The monitoring and review process is pretty important too. How do you review the portfolio? Is it quarterly? Is it annually? Does the investment committee sit down quarterly to review it? Does it look at it annually and say, okay, where are we at? You don't want to make changes, or the market may be down, but you just kind of want to see how you are doing versus the benchmarks and the indexes. And it's going to be accomplished by, you may look at the portfolio and say, okay, now we're down 16%. What happened? But there's also things like an RPAG report we run for clients where it says, okay, the portfolio is still in line. Here's the different funds. Here's a score on each fund from 1 to 10, where it may rank them on, relation to that mutual fund, that mid-cap mutual fund, relation to the mid-cap index, or is the manager still there, or the expenses in line, or how does it, like, where did it rank in regards to these different risk characteristics? So it can give the board a score and say, based on what you're doing, we know you're not all financial advisors or investment committee members. Like, you're not looking at the mutual funds every day, but based on our scoring system, here's where the funds are at, and here's how they're doing in relation to everybody else. So it gives you really just a guideline to review, and kind of keeps your fiduciary duty. And the last thing too we'll mention here is just the acknowledgement. So you put this all together and you just want to have it signed and made sure that everybody acknowledges it, and everybody's in agreement to it. Generally, president or director may sign it, but it's really just a good thing to actually acknowledge that you did it. So we have sample investment policy statements and guidelines we can share as a resource for boards. So if anybody ever wants one, we have sample ones, and we like when organizations have cash and they want to invest it, we'll provide them and help them kind of think about things and what to do. But just let us know, and I'll be happy to send them to you. So let's talk a little bit about the key roles of the fiduciary board process. I'm trying to remember when we have our next poll, but I don't think it's there yet. So the key roles is the fiduciary view. On boards, everyone has different backgrounds and expertise. So not everybody's a financial advisor, not everybody's a lawyer that can read a document, but you want to make sure you have a diverse board that can look at the funds and what they're doing and why they're doing it, and the purpose of the board. You want to look and see, when you're choosing a financial advisor or investment advisor, you want to make sure they're fiduciary. So you want them to be doing what's in the best interest versus merely what's suitable. And that seems like it should be a common thing, but it's becoming more common than it was in the past. But you can really take a look, and you can look up and see, is your advisor a fiduciary, or do they have to do what's suitable? And what that means really is, with suitability is, you can have investment 1 and investment 2. They both can be suitable for a client, but investment 2 pays the advisor more. So generally in a fee-based relationship, where you're working with somebody that's a registered investment advisor or a CFP, you're going to be a fiduciary relationship. It's more and more commonplace, but it's a good thing just to check when you're reviewing.
Andrew, since we're on the topic of that, sure. I think a lot of people on this call, can relate. I feel like on commercials for investment advisors all the time, we always hear, we're a fiduciary, or make sure, your advisor's a fiduciary. It sounds like from this discussion that you think even for, the nonprofit groups, that the fiduciary route is the way to go.
Well, yeah, sure. Yeah, and most definitely. I mean, And you may have somebody that's not a fiduciary that's what's in your best interest, but it's just a good way to have checks and balances if you can. So.
And then just to, kind of top off this, how does one generally know if your financial advisor is a fiduciary? Is, as fundamental as that might sound?
Yeah, you can look on, and I think we may have a section on this, but you can really look on, search the ADV website or search the advisor out and really do a little research on them, and you can find out pretty quickly. So with a registered investment advisor in a fee-based relationship, it's going to be a fiduciary. Generally, if they're a CFP, certified financial planner, they're going to be a fiduciary. So you just want to kind of search that out and look at it. So let me talk about, if you don't have a finance committee, you're going to want to, if you have investments, it's always good to have a certain couple people set aside for a finance committee to review the IPS and look at annually and look at the portfolio and say, okay, where are we at and why? And it may be that, you do that annually, but, generally quarterly is not bad either. And quarterly is probably best. You want to make sure you follow an RFP process, which is a request for proposal. So you send it out. What process did you follow for a bid? Did you send an RFP out, but Michael's nephew got it because Michael likes him and is trying to kick him business, or why are you investing with a certain advisor? What kind of fees are they charging? Is appropriate for you? Are they fiduciary? So Michael's nephew may be a great kid, but you just want to make sure that they're the appropriate person to do it.
Yeah, and Andrew, we actually just got a great question submitted here. How many people do you suggest should be involved in the process to create this policy? Obviously, no one likes too many cooks in the kitchen. How many people, do you think should be involved in that decision-making process? What do you think is healthy?
Well, if you have the director and a board, or director and a finance committee, set aside a basic investment policy statement. Generally, a lot of them are kind of boilerplate, and then you kind of fill in the blanks. You don't want to. You may not necessarily have to have the whole board, but it could be the finance committee, and it could be a couple people. I would say don't have just one person doing it. But on the other hand, if you do the whole board, I've gotten discussions before where people start thinking about, like, okay, values-based investing. Well, I like this fund. I don't like this fund. Here's what I think we should invest in. And it really didn't follow the alignment of their organization. So you can kind of get stuck on certain things, but a couple of people on a committee wouldn't be bad. And
yeah,
then
I think from a
board agree at the end.
I think from a practical standpoint, if you had more than 5 people looking at that, that's going to turn into a lot of opinion in there, just from what I've seen with some of these nonprofit organizations at times.
Sure. So I know we have another poll question here.
Here we go. How do I know if my advisor is a fiduciary? 1, they will tell me. 2, scan for their microchip. Or 3, search the SEC advisor search tool for a Form ADV filing. Take a minute here so everyone can get their CPE credit.
I'm going to answer B, Christine.
I'm sure you are. And actually, well, there we go. We already have an answer. Okay, 16% expect to just be told. 3% are looking for the microchip. Michael, they must be your friends.
Yeah, I'm friends with 3% of people in here.
81% is they're gonna search the SEC advisor search tool for a Form ADV filing. So very, very good. And there are some new questions coming through. Michael, do you want to grab those?
Yeah, absolutely. Let me scroll up here just one second. Yeah, good question. If we have a good policy and identify a set of index mutual funds that meet the objective, do you really need a fiduciary to manage the investments? In most cases, these folks don't actually do anything but try to get you to trade more. They aren't acting as a fiduciary, but as a stockbroker. I think that's an excellent question. Andrew, your thoughts?
No, it's a good question. So it may be that you have somebody on the board that's very knows investments and really knows what they're doing. But at some point, that person's going to leave. So if you're using index funds or things like that, like you want to be able to have a committee really to rebalance. But in a fee-based relationship, if somebody is using ETFs or mutual funds or individual stocks, if the portfolio is large enough, or individual bonds, like they're not getting paid anymore to buy or sell. So even if they're rebalanced and it's a fee-based relationship, and you may say every quarter, you see 15 different trades because they have their, internationals buying and large cap selling and doing things like that. It doesn't mean that that investment advisor is getting compensated anymore. It's all based on your fee relationship. So that should be outlined on how they're getting paid. And so a fiduciary has to do what's in your best interest and doesn't make any more money based on trades.
Yeah, and I'll say this too, Andrew, and I can think of at least a few clients off the top of my head where, that is what they do. They have their own, investment committee, and then they don't have an advisor or fiduciary. They just kind of do it themselves with index funds. So that it's not uncommon. I think that's a good question, but that's good insight, Andrew. And then another good question, on the line here. Do you suggest that the finance committee and investment committee, should they be separate?
Well, really, it's kind of interchangeable. So if you had a large board, maybe, but the finance committee, really, the investment committee kind of falls under the finance committee. So, no, probably not. So, it's kind of a jack of all trades under the finance committee.
Gotcha. And we are getting some really good questions here. Another one. Is there a dollar threshold when an IPS becomes advisable, or when diversifying funds from local financial institutions to stock market investments?
There really isn't. So we had an organization that started with, they were getting a donation for a specific goal. So the donor is saying, I would like this donation to go to X, Y, and Z. And so they put out an RFP. We answered the RFP. We won it. It was for $100,000. We put together the IPS for them and helped them with that. Next, they started having excess funds during 2019 and 2020 of COVID. So they started building a portfolio, and they had a separate fund for that. So that portfolio built up to, I believe, a little over $1 million now. But they basically, the IPS separates the two funds. So if you have something where it's an investment for the long term and you want to distinguish what the funds are for, and versus throwing it in the market and hopefully things work out when you need the money, that's really what the IPS is for.
Yeah, I think another good practical example I've seen to that question. We have one client, granted it's a unique nonprofit, but due to grants they get, they will sit on millions of dollars at a time. And, the question every year when I go to the board meeting is, do we keep it in cash, or is there a certain dollar threshold when we should, put this in an index fund or, something in the market? So I think in a scenario like that, that's a good, practical, example of that question that was just asked.
No, you can have an investment policy statement where you have, 75% cash, or, a certain dollar amount of cash, or 6 to 12 months of the operating budget in cash. Like, you can distinguish that. And the great thing right now is, what stinks with rates going up is bond values have gone down and stocks have gone down. But the nice thing is you put in cash right now and earn 3% in the money market, or you can earn 4% in short-term CDs and treasuries. So you still want to have that money set aside. But an IPS, even if you're holding a lot of cash, may not be a bad idea.
And I'm sorry I missed this earlier, but someone's asking, who do we contact to get the sample investment policy statement? Andrew, would that be you?
Yeah, we can. I can provide that to you guys and afterwards, or we'll get it. Just put a note in there and let them know you want it, and we'll get it to you. So
good deal. That's all I got, Andrew. Do you want to continue on?
Yeah, I'm getting close to the end here. So let's talk a little bit about the landscape in the market right now. So not a whole lot of prognostications, but where we've been, there's been a lot of volatility in the market this year, and a lot of organizations are feeling this. So S&P 500 has been down about 20% year to date. A lot of that's been due to inflation. So inflation's been running about 8.2%. It's starting to tick down a little bit. The Fed's been raising rates a ton, like everybody knows, but the hard part is when rates go up, bond values go down. So aggregate bond index right now has been down about 16%. U.S. stocks have been down about 20%. And if you have international, it's been down a little more than that. So, and this has been the worst year in 100 years for a 60-40 portfolio of 60% stocks and 40% bonds. So, you know, thankfully, I think they're still counting some ballots somewhere, but we're through the political season, which is going to be nice. And we want to talk about politics or presidential elections maybe for another 3 months. But I always tell people the definition of politics is really poly is Greek for many, and then ticks is blood-sucking parasites. So I think everybody's going to be happy to be done when we're done with this. So, but yeah, I mean, the current landscape long-term is the American economy is amazingly resilient. So if you're starting to see inflation tick down and the Fed start to back off rates, or, you know, the war in Ukraine, there's a lot of different things going on right now. But I think if some of that starts to calm down, you're going to see, you know, a better run in the market. But we could have a recession too. A recession doesn't necessarily mean the market's going to be bad for the next few months. A lot of times in the beginning of the recession, the middle of the recession, the market starts going up. So it's tough right now. Everybody's kind of gloomy right now. People are done with the news and politics, but you want to still stay focused on the long term. So.
Yeah, you know, Andrew, you just, you know, obviously talked about a list of things, but, you know, you mentioned interest rates going up, inflation through the roof, people are paying more at the grocery, oil, all that fun stuff. You know, I think all of our, you know, listeners, you know those issues. You know, what can those listening, I mean, what would you recommend to them in terms of, you know, maybe investment strategy, you know, heading into kind of this uncertain economic time? Are we in a recession? Are we not? You know, what would you tell those on the call, and, you know, from a strategic perspective?
Usually my advice is pretty boring. It's like, stay focused on the long term. You know, you don't want to, in 2020 when rates are low, everybody's locked down, everybody's using technology stocks exploded, Facebook exploded, Microsoft exploded, but that run came to an end. And then, you know, during COVID oil prices were negative, and now they're back up because everybody's traveling again, and, you know, you have a limited supply with Russia and Ukraine, and energy companies are up. So things change all the time. Like, you want to be diversified and you want to focus on the long term, and be spread out across your investments. So.
Makes sense. And, you know, guys, I got another question in here before we, you know, conclude this thing. Sure. You know, the question is suggestions. Do you have any suggestions on the language or best practice policy for adding money to the endowment based on end of year fiscal year with funds available, you know, in a checking or savings account, you know, with the said nonprofit?
So, yeah, I'm reading it here too. So, well, I mean, this kind of goes back to how much do you want to have in cash? Do you want to have set aside a year or 6 months or a year and a half of cash? You know, what money, is it a percentage of your budget that's, you know, towards the endowment? Is it, if you're over a certain threshold, does it go towards the endowment or investment accounts? But it really is dependent on, you know, what your current cash flow is. Sometimes people have a little more standard cash flow. They know where they're coming in. It's steady, donors are steady. But sometimes, like to your point, is it maybe you have large portions that come in at once, and you may say, okay, we got way more than we need right now. Let's go ahead and set that aside for the long term. So it really depends on the organization.
I think, I mean, Andrew, is it as simple as it just boils down? It boils down to, you know, what do you want your asset allocation to be? Is that kind of the simple answer to some extent there?
Asset allocation, risk, when do you need the money? Yeah.
Gotcha. Okay, that's a good question. You know, obviously we're about at the end here, Andrew, and, you know, I assume most people on this call, you know, probably have, you know, a financial advisor helping them or guiding them. You know, in the event they don't, though, or, you know, maybe they're sitting on a bunch of cash, you know, exploring this, you know, what would you tell them in terms of traits to look for, you know, in a financial advisor? You know, what would you tell these people?
Other than somebody like me?
Yeah.
No, I mean, just kind of what we covered right now is just looking for a fiduciary, and then, you know, maybe talking to other organizations to find out who they're using to, or you just want to make sure that when you're sending out RFPs, so like when we answer RFPs, is we have experience with nonprofits. Like, we've worked with nonprofits before, we can provide a sample IPS. So you want to make sure that people understand the nonprofit world and what they do and why they're doing it, care about the mission, but also are fiduciary and can help you navigate working with boards, because working with boards is a little bit different than working with individuals. So you got to make sure you have someone experienced. So
yeah, and then you know, this might ultimately be our last question, but and this is a good one, I think. How often can an organization change that investment policy statement?
I mean, honestly, as often as they want to, but that's not a best practice. I mean, you don't want to tweak your asset allocation or your investments based on market conditions. But if you have new money come in, or you have new funding sources, or you want to have a new objective, or you want to tweak it every so often, or you're reviewing it and you notice something, you can tweak it every year if you wanted to. But there's generally a range for, like, here's what the investment side is. It may be, we can have anywhere from 50% stocks to 75% stocks. So there's a pretty wide range on things like that, but we don't see them updated a whole lot, but maybe once every 2 or 3 years. But you can always review it and see.
Gotcha. I think that's a good question. Well,
Okay.
well, I know we're about at the top of the hour here. Sorry, Christine.
That's okay.
I stole your thunder there. Looks like we're about at the top of the hour here. Andrew, thanks so much for joining us. You know, I think this is really valuable insight for those who tuned in, and I know this is something we're all thinking about kind of heading into, you know, 2023 as, you know, we look at kind of year-end planning in particular with our investments. So thanks so much for joining us. You know, if for some reason you think of a question afterwards, you have our contact information, please feel free to reach out. But with that, I will let you guys go, and thanks so much for tuning in.
Okay,
Thanks, everybody.
You're going to see a short survey, and you'll need to complete that to get your CPE credit. And as I reminded you earlier, the certificates will be emailed after the program within 2 weeks. This does conclude our discussion today. Don't hesitate to reach out to us for any further questions or conversation. Thank you so much for joining us, and have a great day.
Hey, thanks, everybody.
Thank you.